Today, I want to talk to you about a topic that you may have heard about or keep hearing about a lot lately. And it's because you are wasting your time. You are brainwashing yourself. You're taking a gun, essentially, and sticking it to your head and pulling the trigger. That is what one does when they tune in to the media. Now, some of you may be getting sick at me emphasizing this, but I'm going to keep telling you this until the day I die. I'm going to keep emphasizing the media is the biggest enemy of the American people. It is your biggest enemy. It's a bigger enemy, a bigger problem than even the banks. Yes, that's correct. Even the banks. And of course, you have the same people who own the banks that own the media. That's another story. But this issue, this topic that you're hearing by this media, by the clowns that are interviewed by the media, is of course the bond bubble, the so-called bond bubble. Now, who has been talking about the bond bubble, the so-called bond bubble? Well, of course, it's the doctors of doom, the douchebags, the charlatans, the gold pumpers, the guys that have taken on a new career. This is a new career opportunity. This whole crisis has presented a new career opportunity, has boosted the career of previous doomsday doctors such as Mark Faber and Peter Schiff and so forth, and it has ushered in a new generation of doomsday guys who are younger and who will continue to preach this until the day they die. You see, that's how it works, people. The point I'm trying to make here today is that there is no bond bubble. That's a bunch of bullshit. Now, I advise many funds individually. I also work with fund managers who often ask me about their own accounts and so forth. Now, I don't provide that personalized advice for a fee because I'm not registered to do so, but I will provide them with advice pertaining to their fund. And of course, I'm sure that they will utilize that advice for their own portfolios. I even have bond fund managers consulting with me, asking me for my views on certain things. And, I'm certainly not a bond fund manager. That's not my forte. I do know some things about it, but I would certainly not claim to be an expert in fixed income investments. I have not spoken to any bond fund managers directly about this issue, but I'm quite confident they will agree with me because they know what's going on. And the fact is that there's no bond bubble. That's a bunch of baloney that's created by the doomsday doctors, okay, to scare you. You see, when it comes to anything related to U.S. investable assets, according to the gold-pumping doomsday douchebags, it's bad, right? Bonds are bad. U.S. treasuries are bad. Stock market's bad, right? We notice the common theme there. Anyway, the point I'm trying to make is that when one calls it a bond bubble, that's very misleading. And, a bubble implies that you have an asset that has been purchased in great excess over a long period of time, such that the valuations are extended. You're talking about very overvalued assets, and it's going to correct and cause a lot of problems. These doomsday guys are referring to the fact that investors have been purchasing bonds for several years, especially after the financial crisis, as interest rates were collapsed down to near zero. Of course, investors piled into bonds as the global economic risks continued to increase. Investors piled into U.S. dollar-denominated assets because they are the safest in the world. And of course, over the past 30 years or so, interest rates have generally trended downward since the very high inflationary period of the late 70s, early 80s. And at that time, of course, the interest rates were, I don't know off the top of my head exactly, but if treasury bills were probably, 15, 16, 17, 18%. It's at one point. So, of course, interest rates have gone down gradually over that time. Now, don't be confused. There have been periods, 3, 4, 5 year periods where you have seen interest rates go up and down, right? 3% to 5%, down to 3%. So, but overall, over the past 30 years or so, interest rates have generally trended downward. And so as interest rates have gone down, of course, investors have bought into bonds because you want to buy bonds when you think interest rates are going to go down. And if you buy a bond and interest rates go down, the price of that bond goes up. So you have capital appreciation from that bond. So obviously, with the period of around 30 years of decreasing interest rates to the point where they're near 0% now and have been for some 3 to 4 years or so, obviously interest rates have nowhere else to go but up, right? It's pretty obvious. And the question is really when. Now, I don't think interest rates are going to move up appreciably before the next 2 years. They will probably go up some, but not that much. The real question is when are interest rates going to go back up to the mean? And the mean is, depending upon the time period you are considering, the mean is anywhere between, 4.5% to 5.5%. Once again, it depends upon the period. If you're looking at a period of the past 30 years, obviously it's going to be a little higher mean. If you're looking at the past 100 years, it's obviously going to be a little lower, right? Because we have that very high period in the late 70s, early 80s. So the point is that it's a natural process that investors have bought bonds. It's not a bubble. It's not a bubble. The movement, the allocation of assets, of cash and other assets into bonds has been a natural progression. So there's not a bond bubble. Now, will the bond market face a sell-off? Well, once again, interest rates have nowhere to go but up. Depending upon how the Federal Reserve decides to handle the end of quantitative easing, and more importantly, depending upon how the Federal Reserve decides on how to begin raising interest rates, that will in large part determine to what extent the bond market sells off, over what period, and so forth. Now, over the past few months, we saw how a misinterpretation or a misinterpretation by investors of the Fed, or a miscommunication of the Fed to investors. And I think it was a combination of both. We saw how that led to a very rapid exodus of investors from the bond market. So the point I'm trying to make is that these doomsday morons have been trying to scare you, to make you think that there's some type of a bubble in bonds that's unjustified and, it's just a smoke and mirrors. And that's complete bullshit. It has to do with interest rates, okay? Now, I want to be clear because I know there's a lot of people out there who only understand, they only see black and white, and they lack the ability to look at shades of gray, of which most things are comprised. And what I mean by that is I can see people now coming back in a few years and saying to me, oh, well, look, you said there wasn't a bond bubble. And look, bonds have gone down. You were wrong. There was a bond bubble. Okay, I hope you understand the distinction that I've made. And this is why, by the way, most people just don't get it. They don't get what I'm saying. They either go with the doomsday morons or the Wall Street perma bulls. I'm the guy that predicted a depression. I'm the guy that predicted a collapse in the stock market. I'm the guy that advised to buy gold and silver, amongst other things, right? But I'm also the guy that told you when to be cautious about gold and silver. I'm also the guy that told you when to buy the stock market, and that was at the exact bottom. So I'm not a one-way Charlie. I shift gears. I know when to shift gears, and that's the way it's done. The vast majority of people are used to some moron who's got a sales pitch and stick with their sales pitch forever. And the problem is that people are not aware of this. They're not consciously aware that they're following some sales pitch, you see? So, anyway, let's go ahead and listen now to what Jim Rogers has to say about the bond bubble.
another critical week as investors wait to see if the Fed will try to kickstart the recovery with more cash when it wraps up its policy meeting on Thursday. Joining me for our latest Economy 2012 series is international investor and author of A Gift to My Children, Jim Rogers. The Fed is widely expected to announce more stimulus this week, but will it actually help the U.S. economy?
No, Elizabeth, of course it won't. QE1 failed, QE2 failed. You really think it's going to work? Never in history has printing money made the fundamental change in any economy. Of course, it blows up a few sectors for a while, improves them for a while, but this is not going to solve our problems. This is going to make our problems worse.
Sound familiar, people? Whenever someone asks Jim Rogers, you'll notice his dramatics. Whenever someone asks him about, is this going to help? Is the Fed going to help? No, right? And by the way, what's the first thing you noticed when they showed both of these individuals? Did you notice the Jewish lady's boobs? Right? Did you notice that? Let's have a look. There we go. You see the boobs? Notice she's wearing this, I don't know, what is that? Looks like a girdle or something, some medieval girdle to pop her boobs out. If you think this is not intentional, if you think this is by accident, then you don't know how the media works. It's pretty obvious, right? Media wants to sell sex and they sell boobs, and Reuters and Associated Press, they have really stooped down to the lowest level over the past several years. And they used to be somewhat reputable, credible news wires. Now they're getting into the business of commentary and opinion analysis and so forth and manipulation. And now we see they're getting into the CNBC Fox Business News boob contest that I've discussed and written about on numerous occasions. These are things that you need to be aware of. You need to notice. You need to start paying attention. If you start to pay attention to things, you will be more aware of your surroundings. You'll be less likely to be fooled by charlatans. Of course, the easiest way to avoid being fooled by charlatans is just to tune out of the media.
So let me ask you, the last time you were here, you told me that, get ready for something along the lines of an economic Armageddon for 2013 and 2014. Do you think that the Fed is going to push the U.S. into recession?
Well, as long as they continue to print money and
she's basically setting him up. She knows the answer. Yes, of course, the Fed's going to do it. Now, make no mistake, I don't like the Federal Reserve. I've written a lot about them. I've exposed them. I'm the only person in the world in the financial industry that has labeled them the Jewish Mafia. So obviously I don't like the Federal Reserve. I have exposed them more than anyone else in terms of labeling them for who they are. But at the same time, I just want you to understand that playing this Fed boogeyman thing, this is playing on your emotions, and this is the way these gold pumpers work. You hate the Fed, you hate Wall Street. Yeah, it's the Max Kaiser strategy. Yeah, buy gold. Yeah. You understand, people? Listen, just because you don't like Wall Street, just because you don't like the Federal Reserve, doesn't mean you go to someone else's alternative. Anyway.
Build up debt? Yes, of course. The solution to too much debt is not more debt. Come on, nobody except a politician would say something like that. There is an election in 2012. There is an election in Germany in 2013. So everybody's doing their best to hold the world together. Be very worried after those elections.
So there's nothing the Fed can do to avoid this?
Yeah, they could resign.
Rogers has been predicting Armageddon for I don't know how many years now, but she mentions his prediction as of late, 2013 and 2014. You see, and of course, it's 2013 now. So far, we don't have any Armageddon. It's the middle of October 2013. Now, of course, he'll say, well, 2014. 2014 will come. He'll say, well, 2015, right? It's kind of the John Williams strategy, right? The Peter Schiff strategy. It's coming. The real crash is coming. It's coming. In the meantime, buy gold so I can charge you 10%